What's up, Gould Miners? In today's episode, we welcome to the show Amy Rubenstein, the CEO of Clear Investment Group, a private equity fund that specializes in multifamily investing. Amy now has over 2 decades of multifamily investing experience, and she is a treasure trove of knowledge. We really cover the gambit when it comes to topics on today's episode. We start with Amy's background in theater, and then we quickly shift into some of her investing strategies and why she has chosen to invest primarily in Class C multifamily. We also spend some time talking about first-time investors and the importance of building the right team and surrounding yourself with the right people at the start. And finally, we talk about the current market conditions, what Amy and her group are doing to overcome the conditions, and how you can overcome them as well. Lots of knowledge bombs being dropped in this episode. So without further ado, everyone, let's welcome to the show, Amy Rubenstein. Amy, welcome to the Gould Mine.
Thank you. I'm happy to be here.
Yeah, well, I know that we share like a very common background. So I don't know if you know this, but like I have a theater background as well. And I was also a realtor. So
that's great. There's not that many of us.
I know, like actor turned realtor turned real estate investor. So how does that happen? Because you must get that question a lot, right? Because I know I do. They're like, how did you fall into all of that sequentially?
You were an actor?
I was yes.
Background? Yeah.
Mm-hmm.
Yeah. Mm-hmm. I think it's I think because real estate is a relatively easy field to jump into without a huge background in real estate, for better or for worse. Anyone can enter the game of real estate. And I think that sort of, and then you can work the hours you want to work. And I think that flexibility paired with a artist lifestyle is a good pair, but it does use different parts of your brain. So it is unusual. I don't often meet a ton of actors who.
How do you feel like that background has kind of influenced your approach?
I think it makes me a better problem solver. I think it was a blessing and a curse that I came into the industry without a ton of preconceived notions. Also with running a team, I haven't really worked for another large company or any other company, really. I had lots of odds and ends jobs, but I never worked for a real estate company, and so I didn't see how other people did it. And I think that has a lot of negatives too, right? There's a lot of reinventing the wheel. But it also allows us to come at things with a fresh set of eyes, to come at problems in creative ways, and not to have any preconceived notions of this is how you do things. So, pluses and minuses.
Yeah, no, absolutely. And I really, that's an interesting take on it. Like it makes you a better problem solver. Well, you and I both know real estate is all about solving problems, right? Like the bigger the checks, the larger the problems you solve, right? So It's interesting that you say that. Here's another question for you, because there might be some agents listening to this podcast right now. And there's this weird thing where like, it's like the dealer that doesn't like dip into their own stash sort of syndrome, where like realtors and brokers don't often kind of make that leap into real estate investing. I don't know if you've noticed that as well, but I certainly have noticed it here in my area, where, like a lot of the realtors here in the area don't even own their own houses, right? So like, how do you break that cycle?
To start investing in real estate?
Exactly. Like, especially like being in it, right? Like a lot of realtors don't even start.
Yeah. It's funny because I used to ask brokers that all the time in the beginning of my career. People, brokers can make really great money and really large check sizes without a lot of financial risk. They're risking their time or efforts because you can get through a lot of deals that fall through. But you don't have to put up capital to be a real estate broker, other than the rent for your office and your staff and such, and that's not nothing. But it is I think, a less risky path and you can broker through any market. And so I think people get used to that income without having to take those risks. And when you look at going into a real estate deal and putting in a large chunk of money, doing that the first couple of times is kind of hard to swallow. So I don't know.
Interesting.
That's my take.
Yeah, that's interesting. So kind of walk me through the path that you took, because it's definitely an interesting path. So you're in the theater, and then one day you just say like, I'm going to start selling houses, right? So and then eventually you start investing into multifamily. Walk me through that journey.
So I never bought and sold houses for other people. I never brokered other people's deals. The way that I started was very accidental. I ended up buying a home and having to sell it 6 months later, and that wasn't the intention. I had nothing to do with real estate before, but when I bought the house, it was kind of a mess, and I fixed it up. And then when I sold it, I made money. So I thought, that's kind of interesting. And so then, having moved from there, I bought a condo, and the same thing happened, and it increased in value. And I thought, well, this is a whole lot easier to make money this way than all the other odds and ends jobs that I had as an actor at that time. Waitressing, I was substitute teaching, I worked in retail, like all sorts of different jobs.
Yeah.
And so I decided to learn a little bit about real estate. What was it, and how did it work, and how could I keep doing this? Because I thought, well, if I could do this with a house and a condo, maybe I could do this with a small apartment building. And so I studied to get my broker's license. And I had a friend who was working in investment banking, and he came across a model that analyzed multifamily deals, apartment deals, and shared it with me. And I started playing around with it, just analyzing deals that I would see. Until I felt like I understood it. And I found a deal that I thought was great. And at that point, I knew this much about real estate, a teeny bit. And I went out to a couple friends and family members and said, hey, look, I want to buy this apartment building. It's 6 studios. It's all vacant. It needs to be fixed up. And it's in a great area. And I think I can turn it around and sell it. And so I got a couple people to say yes. And did everything, kind of get it all going, and leased it up, and put it on the market and sold it probably about 6 months later. And this wasn't because I was so smart. This was because the market was going up. And there was value add to it. So, that is what I do now, is I only buy deals that have extreme value add to them. The value add was, this was a vacant building that was sitting there. It needed to be fixed up and leased. And so that was the value add. But it was pushed forward and propelled by the fact that the market was rising. This was in 2003 that I bought my first building, and that's how I got into real estate. Sold that one, bought 2 more, sold those 2, bought 4 more, and kept going from there.
So you mentioned that you do like a lot of value add, and I know that like the majority of the properties that you buy are like primarily Class C. Come walk me through, is that correct?
Yes.
Mostly Class C. Yeah. So walk me through why that is. Like why have you chosen to focus on that asset, like that specific class of multifamily?
Yeah, I really love C-class assets or workforce housing for many reasons. Over the last 20 years, I've dabbled in all sorts of real estate and all different asset classes, but C-class is where I've really loved the most, where I've really done the best. A few things that I really love about it. I take over properties that are having a lot of problems, and I can turn them around pretty quickly. And I love seeing that transformation. It's very, very tangible. I can watch a property get cleaned up in a pretty extreme way. And you don't always get that with other asset classes. With A's and B's, they're not always deteriorated enough where you get to see that lift. And with D classes, you can't always get it to a better place. And so that's one of the reasons I really love C class. You can really see and feel the differences. I also really like the renter base. These are people who are going to be lifelong renters. They're renters by necessity. We're not competing with the home markets. We are trying to provide people with the best product possible, somewhere where they can feel safe to live, a place that they can feel proud of. We really love making our units look great and feel great, so that people are loyal to us, so that our tenants can see that we care and that we put efforts in a different way. When you're a Class A landlord, you're really focused a lot more on the design side, the amenities, the really higher end things. You're catering to a lot more disposable income, and I don't have that vision. I like to provide the basic needs in a really productive and beautiful way. It's just different. And then also the numbers in Class C real estate don't really compare to Class A real estate as far as cash flow. You just get a higher cash flow in Class C.
How do you balance the need for like short-term returns? How do you balance that between like, okay, for example, you're renovating, a Class C that's going to take a lot of cash infusion, right? Like that's going to take a large cash infusion to kind of get it up to speed. So when you're like underwriting these deals, how do you balance out the initial cash infusion with like the return aspect of it? Like what are you looking at in terms of your underwriting model? Like how do you balance the upfront cost versus like the long term, like the need for the return? So like, how are you looking at those?
Yeah. So in the short term, when we're looking at a project, during our due diligence period, we're figuring out what does this project need as far as a capital infusion to get us to a place of stabilization. And so for stabilization, we're going to consider that to be market occupancy. So it's usually in the mid 90% range, or whatever that particular market is, somewhere between 90 and 98%. We're going to say rents are within a certain amount of market rents. When we look at market rents in a submarket, we're looking at like, what are the average rents of our type of asset class? We like to be right in that middle range. And then we're looking to make sure that we've taken care of all deferred maintenance, and that the buildings are safe and habitable, so that we don't have any code violations. We've beautified them a bit. So those are the things that we need to get to. And so when we're analyzing building, we're saying how much is that going to cost for us to get there? And how long is that going to take? And we're taking that upfront investment and putting into the deal basically as if you're adding it to the purchase price. And then we're making sure that once we are stabilized, that we're hitting a certain return. So the short term is about infusing the property with the cash that it needs and the work that it needs to get there. And then the long term is, once you're there, what does that cash flow look like? We happen to be short-term holders, so we are really taking a project to stabilization. At that point, we're usually out of the deal. We usually sell the deal at that point. And that could take anywhere from 2 to 4. Well, usually a stabilization for us is 12 to 36 months. So we're usually in the deal for 2 to 4 years. At that point, then our plan A is that short-term plan. We're going to get to stabilization and we are going to sell. Our plan B, if we couldn't sell for some reason, is that we're going to sit and have cash flow. That is that long-term plan. We're just not long-term holders. But if we were, that would be the long-term plan, is to sit now and reap the benefits of what you've just, the position you've just gotten that property into.
Yeah, absolutely. So, and that makes perfect sense. So you typically have like less than a 5-year hold period. You're looking at like a rehab phase of like 12 to 24 months, depending on the project, right? And then usually a stabilization period of like another 2 to 4 years. And then we're selling usually in that like 4 to 6 year window.
Usually 2 to 4, but yes.
2 to 4. Like from the time that you close on the property to the time that you sell it, it's usually a 2 to 4 year time period.
Correct.
That's awesome. Okay. Got it. So in other words, you are, for lack of a better term, like most of these multifamilies you're flipping, right? So you're essentially like rehabbing the property, restabilizing it, and then exiting.
Correct.
Yeah. So would you say that, like, for someone, for example, like for someone that has like a lot of experience flipping single family homes, have you done any single families, Amy?
I did in 2008-9, when the world started to change. I was working in Los Angeles. All of our deals were in Los Angeles at that time. And the market really froze up for apartment buildings. So we weren't able to really buy or sell anything. And we needed, and at the same time, it was a rough time for landlords or for lots of industries. But rents were really dropping and occupancy was really dropping at that time. And so we needed a way to make sure that we could infuse extra capital into the property. And the only thing that we could find to buy at that time was houses. There were a lot of foreclosures at that time on houses. And so what we started doing is there was a bit of a loophole in LA County where you can add a 500 square foot addition without permits. And so we were able to start adding bedrooms and bathrooms to entry-level homes. And at that time, people were struggling to buy foreclosure homes if they wanted to live in them, because the lenders were not lending unless the home was in perfect condition for new buyers. And so we served as a middleman in this point where we would buy houses that were foreclosed on that needed a fix-up, and then selling them off to entry-level buyers. And we did about 70 single-family homes in 18 months. So
wow.
But that was really my only experience with home flipping.
Got it. Well, I mean, that's 70 houses, right? So that's quite a few.
It was a lot.
So what are the core differences? Like if someone is in the single family space and they're thinking about making the leap into multifamily, what are some of the core differences that you experience between, say, rehabbing a single family to rehabbing an entire like apartment building?
Yeah. So I stayed in that same world of C-class when we were doing the houses. We weren't renovating, a luxury homes. And so in that sense, it was very similar. We were trying to be very practical about what we were doing. If the lifespan of the kitchen cabinets were not completed, we were going to repair them, upgrade them, paint them, as opposed to replace them. If they had seen their life, then we would replace them. But it's that same sort of idea of keeping what you can, renovating what you can, and replacing what needs to be replaced. We're not trying to hide anything or put a mask on anything, but we try to preserve any sort of value that does exist and then enhance that. So in that sense, it's very similar. The difference is what is your exit strategy? It's your buyer pool that's very different. So and that changes as you grow in size of whether it's a house, a small apartment building, a mid-sized apartment building, a large apartment building. But for houses, housing sales are very different than apartment building sales because you are selling to the person who's going to live there. So it's a very emotional decision. So you want to do things to make the home feel like someone is going to put their life investment into this and then move their family there for a permanent period of time. That's very different than selling to, it's more like renting an apartment than selling to an investor who is going to go rent these apartments out to other people. So it's a little bit less emotional when you get into apartment buildings. It's more about math, whereas homes are more emotion driven. Yeah,
I totally get that. Switching topics a little bit, because you had mentioned the LA market and that kind of piqued my curiosity. So which markets predominantly are you focused in right now?
So we look everywhere around the country. We will really go wherever the deal is. We have a minimum size of 300 units for a submarket to enter a new submarket. So because of that, we're able to really jump around if we have that minimum size that allows us to set up shop in any new submarket. So Florida, Texas, Louisiana, Georgia, New York, Illinois, Ohio, Washington, D.C. We don't do We really haven't bought in California in 10 years. It is just, we tend to not buy any primary locations or primary cities. We don't buy a lot in New York City or in California because it is so, it's so focused, the market's so focused on appreciation, natural appreciation, that the numbers don't make sense to me. Mm-hmm. You just can't see a lot of cash flow in those markets. And so we tend to stay away from them.
They don't make sense to anyone, Amy. It's not just you.
Well, I spent 10 years in that market. And so even then it didn't make sense from a math standpoint, but we were really buying into the appreciation side of it. And at that point was quite a bit of speculation about what the market is going to do and the continued appreciation of that market. And we never really cash flowed. For owning those properties for 10 years in California, we never really were cash flow people. We were still adding value and selling, but we would operate without cash flow and sell without cash flow. And the next owner would take over without cash flow. And that was just how California market works. And if you're in it, you can kind of see how to stay in it. Well, as soon as you get out of it, it's almost impossible to get yourself back into it because you're making, you can make 10 to 12% cash flow anywhere outside of California. And all of a sudden you want to go back to California and not make anything. It's very hard to jump back into that.
I could definitely see that. And, it's an interesting thing right now because there are certain markets in California, for example, like San Francisco, right? So when I'm here in the Bay, so when people ask me, hey, where's the best place to invest? I tell them, I believe the best place to invest right now is San Francisco. And I wouldn't personally do it, but I think it's the best place to go because there's so much opportunity there. The real estate is super, super cheap compared to where it was before, but you're banking on something that may never happen, which is the market turning back around.
Correct.
Right? So
it's a lot of speculation. And I agree with how there are so many deals to be had there, but you have to have, you have to be willing to have a business that is based off of speculation. But that's not to say that people who buy there are going to be the ones who, 10 years from now are just rocking it. I tend to be a much more conservative investor, and I don't like to invest in any market that's deteriorating or that's shown deterioration over the last years. I like to invest in things that show a lot of stabilization over the last decade and are pretty flat. So it's not for me, but I agree with you that I think there are great opportunities there.
So when you talk about deterioration, are you talking about like the overall like population? Are you talking about just like, so when you kind of walk me through what you mean by deterioration of the market? So what factors are you looking at?
The population shrinking. Yep. So vacancy rates going up.
Gotcha.
Employers shrinking. So I don't like to count on anything that I cannot control. So when I look at all the variables of real estate, I want to make sure that every variable that we model for, either we're modeling for us for it to stay flat or a slight deterioration, or we can control the variable and then we can model for appreciation. But when a market is deteriorating, if you were following the trajectory, you're going down. So you have to be counting on the trajectory to change, and you don't have an influence on that.
Right.
And that's where I won't invest, just because I'm ultra conservative on where we do invest. It's not to say that it's not a good investment. There's lots of ways to play this game.
Yeah, definitely. And to each their own. And I think, you kind of hit it on the head, right? Because you mentioned it earlier, whether you directly or didn't directly say this, it's like, earlier on, you were playing in markets where you didn't necessarily cash flow and you took maybe greater risks. But now, kind of like after the first decade or so, now that you're kind of more established, you're less willing to take those kind of risks, right? So Do you think taking risks at the beginning of your investing career is necessary in order to succeed?
Is it necessary? I think you have to take some risks to make money. Right? But I think the more calculated that risk can be and the more controlled it can be, the better off you are. So it's an interesting question. You have to do that. It's certainly, I would say we took some risks when we were younger that certainly propelled us forward. So I would say lacking a little bit of wisdom and knowledge maybe helped me take those risks. But would I recommend someone to have less wisdom and knowledge to take more risk? Probably not. I think that there's a little bit of luck behind that too,
Sure.
So I do think my father always said this to me when I was younger, that opportunity passes in front of everybody. And the question is whether you recognize it and then have the guts to go after it, take those opportunities. But that opportunity is slightly different than a risk. So it is being willing to step out on a ledge and put yourself out there and do things that are scary and different. But the more you can calculate your risk, the better off you are.
Yeah, I like that. That makes perfect sense. And on that topic, right? Because we're talking about like beginning your investing journey. What advice would you have to someone who's listening to this podcast that maybe is never like they're brand new into real estate investing? What would your singular, like your highest piece of advice be to that individual?
I would say read as much as you can, learn as much as you can, try to find a mentor who's been through a little bit before you. Identify what you don't know and make sure you're aware of that. Even if you can't solve for it, make sure you're aware of what you don't know. I think that's this is the biggest thing. I come across new things every day. I have a massive learning curve every day still. And there's no way for me to learn everything. But that is the key, is knowing, okay, here are the items I don't know. Of these items, which are the important ones that I tackle right now? Which are the most important things that I try to figure out how to learn, or go to someone who knows the answer for these things, or find someone who I trust to solve for some of these unknowns. And so I do think that taking those leaps and those risks, quote unquote, or calculated risks are important. You just want to do that with as much knowledge as you possibly can have.
Yeah, and the self-awareness component, I think, is super crucial. So that makes a lot of sense. Also, something that I talk a lot about in real estate sales, but haven't really discussed too much with like real estate investors, is like this idea of being able to cast your ego aside and really understand and come to terms with like what you bring to the table, and maybe what skills or knowledge you're lacking, and then finding someone to kind of like fill that void or like fill those gaps. So you talk about a mentor, right? And I think that's super critical, right? Finding someone that can coach you. But if you're not willing to basically cast your ego aside and admit that you don't know it all, and put yourself in a position, like a vulnerable position, to really like go to someone and be like, hey, I don't know this. Can you teach me? Can you show me? So when you're like, if you were talking to someone that is just starting in their investing journey, where does someone go to find a mentor? Like, how does that happen?
So I think that brokerage is an incredible way to learn about real estate. So I think that if you don't know anything about real estate and you want to get into it, I really think learning about brokerage, or working in a brokerage, or getting your agent's license and being an agent for a little bit is amazing training grounds. So that's one place to go get it. Is from, and I would say, going to one of the larger brokerages is best because they have really good training programs. Like Marcus Millichap is a really good training program. CBRE, these companies have great training programs for agents. So that is one way to do it. Another way is to start joining some of these local associations, going to some of these local meetings where you're meeting other owners. I would say even as you're looking for a mentor, when you watch other people, when you're watching generally the market do one particular thing where everyone's following a trend, that's not necessarily the way to go. By the time you see the trend happening, it might be over, or it might be just because everyone else is doing something doesn't mean it's the way to do it. So, you often see markets get really, really heated, and then you're playing a game of hot potato, and the last person that makes a move is the one that, gets killed. So it's you just want to be careful of like really following the herd. But I think generally being open, like you said, ego, it is a massive killer of success. You just see things if you're so focused on yourself and you don't have that humble way about you. And so I would say definitely try to separate ego from everything that you do. It would help you find people to mentor you. It helps you. Also, everyone you do business with every day can be a mentor. I find mentors within the guy who runs the HVAC company that we work with, because he's teaching me key things I need to look for in, a new heating and air conditioning unit.
Right.
I find mentors in my bankers who are teaching me about what their views on interest rates are. I can find mentors in brokers who sell to me because they know a submarket better than I do. I learn from people who buy from me and people who I buy from. I always try to keep incredible relationships with the people I do business with because I'm going to learn from them and I want repeat business. It's better for all of us. So I try to find everyone I interact with. I want to learn something.
That's a really good point, and that's something that a lot of people don't really talk about. They talk about the mentors directly in the space, but like all of the vendors and the people that surround you, right? That could also be your network. And you make a really good point. So that's interesting that you say that.
It's also other business owners that aren't even related to real estate. Finding any smart people. All businesses function with the same skeleton. It's just different lingo, right? You can be running a real estate business or a fast food chain or a corrugated cardboard company or whatever it is that someone is running. They really have the same general problems once you get to of a certain size. If you're not a one-man show, right? You have any employees at all. And I think especially, and this comes back to that idea of transferring from one industry to another, going from theater into real estate and coming with fresh ideas. But when you get people from other industries that are giving you fresh ideas to apply to your own business in real estate, that is also really helpful.
That makes a lot of sense. Let's talk about the structure real quick then of Clear Investment Group. So what does the structure look like right now for you guys?
As far as our staff or
like your staff and your team and everything, like how is that structured?
Yeah. So we currently are running a fund. We have basically it's a large pool of money, and we buy different portfolios around the country with that particular fund. And then when we spend all that, then we would start our next fund. So the way that we're structured is we're based out of Chicago. We have about 20 people in our Chicago office, and those people are running the logistics of how the core of the company works. So we're running our back office here, our accounting. We're running brokerage out of here, our buying and selling. We're running our construction management, our asset management from here. And then everything else is on a property based. So then we have our regional managers, our area managers and our regional managers. And then at the properties themselves, we have the head managers and then assistant managers, leasing agents, maintenance staff, construction crew. janitorial staff, and so on and so forth. So I would say each submarket has anywhere from 12 to 25 employees, and then the back office is all in Chicago. Gotcha.
So how many funds have you kind of like gone through? How many cycles of funds have you gone through?
Yeah. For a long time, we were buying our properties deal by deal. So we would raise each individual deal. Mm-hmm. Then we started doing it as regional funds. So we would have a group of properties in certain areas. And then we moved to a national fund. So this is technically our first national fund right now, gotcha. Where we're blending submarkets together. And we really wanted to do that to make sure that there was diversity in our portfolio for our investors. Because what we found over the last 20 years is our investors that made the most money were the ones that were invested in all of our deals. And we wanted to make sure we could give out that smoothed out return to our investors at any, whatever level they're coming in with us, that they're getting the benefit of being invested in many deals.
So you were syndicating each deal like on a one by, you're syndicating each, like a one on, wow, tongue tied there. You were syndicating each deal one by one, and then you moved to a fund model, like a regional fund model. And then you went, full nationals. Do you wish, like in hindsight, and obviously like, hindsight's 2020, but like going back and like looking back at things, do you wish you'd done more of like a national fund model from the get-go?
Yes. In some ways, yes. From the very, very beginning, I don't think we could have learned how to do this on a national level. So I think we had to be local to really learn, because we really had to understand what do we need to watch on a day-to-day basis. So we had to be local, I think, in the beginning to really understand this business. After we understood it and once we were buying nationally, I do think that fund model is a better model for as far as risk, for reducing risk, because there's all sorts of things that could throw one submarket off. We owned a large portfolio in the Panhandle of Florida, but we were constantly dodging hurricanes, and we were lucky. And we never had any issues, but I felt like every week it was like a hurricane was passing us to the left. It was passing us to the right. It was just like a matter of time. That diversity of geography would have been helpful there. Same thing with like during COVID. We saw different markets respond differently on many levels. As far as crime, the bigger cities got hit really, really hard, where our smaller tertiary cities didn't get hit with crime like that. But some of the smaller areas were a lot slower to come out with support, with funding for tenants to have housing support during those times. So every submarket had its own problems during COVID. And I think having that diversity would have smoothed out those problems.
Makes a lot of sense. So this is more like a selfish question, because we spend a lot of time on like asset management and like how to pick the right market and renovating and Class C and all that. We haven't talked about raising capital. What are your core capital raising strategies right now for Clear Investment Group?
Oh my God, it is so hard. Raising money is really, really hard, especially right now. It's funny because it's like the best times to invest are the times when people are the most scared. And I would say right now is one of the best times to invest. And people are scared about the unknown, what they don't know. And so that's another reason, because we also don't know a lot of things. So that's another reason why we have to be so conservative at so many of our variables that we're forecasting. But as much as we explain this out to investors, if someone is just scared of what's coming and they want to have a strong cash position, and they're not so willing to go out and invest in new things, there's little you can do. And we find that to be the general feel of investors right now, is they're generally nervous, and I think, or they want to wait for a big crash to happen. And I personally don't think that's coming. So we're in a down market. Maybe it'll get worse. Maybe it'll stay flat. Maybe it'll get better soon. We don't know, right? But I don't think for a crash coming. But how do you raise money? So I guess it starts small and kind of grows. We originally started with friends and family, and then more friends and family, and then friends and family members of a friends and family members, and then that started to scale out. So I think those are the easiest routes, is high net worth individuals. Yep. When you start going after larger pieces, family offices, institutional investors, they're looking for a lot of track record, a lot of, even for us, we've got 20 years of a track record, and we still, have people wanting to see, many rounds of different funds that are all fully audited. So, wow. A lot of it, the challenges don't end 20 years into it. We right now set out last fall, about a year ago, we set out to raise $75 million for our current fund. We're about 60 million raised from that. And it's been tough, I would say.
Yeah.
A lot of people want to sit and watch for a while. So when you do put a lot of time and effort into investors or taking investor meetings and meeting with people, I would say try not to look at only this current investment that you're raising as the end goal, but you're trying to build relationships. And so often I see someone will sit and pass on a deal and then pass on another deal, and then pass on another deal. And after I show them 3 rounds of good returns that they missed out on, then they're more willing to come in on the 4th. So it just takes, showing everybody, here's what I have right now. They come in or they don't come in, you get a deal done, you move forward, and then you go back and show those returns back to everybody, and you start all over again, and you keep doing that. And just because someone says no today doesn't mean they're going to say no next month or the month after that or the month after that. And I think just keep going at it. People's cash positions change, people's tolerance for risk changes, people's appetite for different asset classes change, and you just keep going back and trying again and again and again.
We're coming up close to time right now, but you had mentioned, I have a couple final questions for you here, Amy. The first one being, you had mentioned the market right now and the conditions, and now being an optimal time to invest because of, how, shit's hit the fan, right? Like everyone's kind of scared and everyone doesn't really know what to expect. When you look at the market right now and you see the opportunity, what opportunities do you see right now? And how long of a time window do you believe that opportunity will be there for? Specifically, let's stick to the multifamily sector, right? So specifically in multifamily, what opportunities are you seeing right now? And how long do you think that's going to last?
So we're seeing right now that pricing for what we're buying is about 30% below where we saw it 18 months ago. So there's been a steep decrease in pricing, and that is very directly related to interest rates.
Yep.
As interest rates rise, people get scared and back away from buying. And so sellers are forced to reduce pricing, especially if they have to sell. We focus on distressed sellers. So when they have to sell and the buyer pool starts to disappear, that's when you start to see reduced pricing. Now, interest rates today are not really that historically high. They certainly are higher than they were 12 months ago, but they're not in a crazy place. And I think if you underwrite for a higher interest rate, then you can pay a higher interest rate. So people say this all the time to me is, well, how do you buy deals where the interest rates are so high? Well, that's just a number. You just use the higher numbers, and now you understand what the deal looks like. So just because interest rates are high doesn't mean that they're bad. It's just another number that has to change in your modeling. It's not a problem. It's just a number. So that's one thing. But that creates opportunity because you don't have as much competition in the marketplace right now. You also get some sellers who were hurt by interest rates rising. So maybe they were on a adjustable rate and their rates rose, and so they have to get out because of that.
Right.
Then you could find deals because of that. But I generally always think there are good deals out there to be had in every market. I'm not a person that likes to sit on the sidelines and wait, because what are we waiting for? That's a speculation. We don't know. I don't like to try to time this market. I like to try to buy things based on what their value is, irrespective of what's going on in the outside market. So with there's lots of ways to look at deals where you can isolate them from what's going on in the marketplace to make sure you're buying a solid deal. But I do think we're in a downturn. I don't know how long we'll be here in this downturn. I think that we probably have some more time. I don't guess that interest rates are going to be slashed anytime soon, which would cause, some wild, buying spree for people. I don't see that happening. I also don't see interest rates, skyrocketing up anytime soon. I feel like we're going to hover within, 100 to 200 basis points for quite a long period of time. But whether, are we at the beginning of the downturn, the middle of the downturn, the end of the downturn, it's really hard to tell. So it's important to just try to keep finding deals that fundamentally work, whether you're at the top of the market or the bottom of the market.
Yeah, and especially going into an election year. I mean, I don't think that nothing really brings volatility to the table like an election year, right? So I don't think that we're going to see any sort of like true stability, and especially like the debt markets, for at least another 18 months or so, because we're about 18 months away from all that being over, and then there's the aftermath of the election, because whatever way it goes, half the people are pissed, right?
Right.
You had mentioned the higher interest rates and underwriting the deal for where they're at today. And I think that's so true, right? Because you're looking at a deal and it's like, hey, it just needs to pencil at the numbers that you're currently working with, right? Like, just because the interest rates are higher doesn't mean that the deal can't make sense. It's just that it has to make sense with the current environment in mind. And also with your strategy, like, correct me if I'm wrong, Amy, but like with your strategy, you're not buying and holding. So those rates are really only affecting you. And you're looking at the rates too, like, well, actually, here's as I'm talking through this, I'm actually realizing something. So how do you factor into your model? Like, how do you stress test your modeling in the case that, like, 4 years from now, when you go to sell it, the interest rates are higher than where they're at right now? So what parameters are you setting, or like what kind of stress tests are you implementing to make sure that like the deal still works for you if the debt markets kind of like go haywire and you're stuck in a position where you have to sell and the rates are higher than where they're at right now? And you might be going through that right now, actually, right? So
sure. So what we look at is we want to make sure that we stress test our deals to go up quite a bit. So like right now, we're underwriting interest rates at about 8%, but at stabilization, we could hit a break-even return if interest rates went up to 15%. So we have a lot of room. That doesn't mean the deal is doing great, but it means we're not going to lose the deal if it goes up to 15%. Right. Interest rates are not going up to 15%. I mean, I can't imagine. I can't imagine that happening. But let's say that they did. We want to make sure that we're looking at what our unlevered returns also are. So we want to look at the deal without any loan in it at all, and we want to see that we can get a decent return if we have no loan. Now that means you got to raise money to be able to have no loan. But our deals are usually returning around 7% if we didn't have a loan. So that's pretty solid. It means our deals are independent from interest rates in many ways. Mm-hmm. We also want to make sure that when interest rates go up, cap rates go up for sales. So if an interest rate's going up, a buyer wants to see that they can buy for a higher cap rate. That's going to help them be able to afford the higher interest rates. And so we model to sell at cap rates that are a full 100 basis points over where we think we're going to sell them or where they are today, so that we know that we have room for the market to deteriorate.
Yeah.
And then we hold any other appreciation, we hold steady as well to help us hedge. So we're going to assume that market rents are not going to increase. Market rent rates are not going to increase for the next 3 years. And we assume that that occupancy is not going to improve. And we just try to look at each variable and say, all right, nothing is going to get better and it might get a little worse. And we stress test for things to get a lot worse. Not that we're going to make great returns if things get a lot worse, but that we're going to be fine. But that given things get a little bit worse, that we're going to be great.
Yeah, that makes a lot of sense. And so it sounds to me like you're looking at a couple different variables. You're looking at the entry rate versus the exit rate, and you're testing to see like how high can the rates go and we still break even. You're looking at unlevered returns, and then finally you're looking at the cap rate adjustments as time goes on and making sure that you're good even if the rate fluctuates a little bit, or the trading rate fluctuates a little bit. So that makes a lot of sense. Amy, in traditional Gould Mine fashion, why don't you leave the audience with a final gold nugget?
I would say this year our biggest focus is on our team and making sure that the team is functioning really, really well. And I think it's more important than ever to, and as our company grows and as I have more time to reflect on what's going on, I just realized that that the teamwork between all of our staff is crucial, and that you could have the same deal do very well or perform very poorly based on the staff and how they work together, the turnover of the staff, the ownership that staff feels towards the project. And so I would say just don't underestimate all the people that you work with, and that it's, it can be a one-man show in the very beginning, but as it starts to grow, every player on that team is so crucial and can really make the difference of a good deal or a bad one. Yeah,
I love that. That's I think that's true across a myriad of industries, but probably not one that a lot of investors think about, right? Because they come into this and it's probably usually a solo play at first, but having that vision of the foresight to know that you got to build out a great team, I think is a great piece of advice. So thank you so much, Amy, for stopping by.
Yes,
and this was a lot of fun. So thanks for coming, and hope to get to do it again sometime soon.
Thank you. Likewise.
All right.